Live. Hi all, I'm Sham and Kishan,
Hey everyone.
another episode of Free Flow. So Kishan, do you want to give intro on what today's topic is all about?
Yes, sure, Sham. So the last two times, we spoke about, strategic allocation, and then we spoke about tactical allocation last week. Um, I mean, we didn't dwell, deep enough, I think, on both these topics. But if we spoke, as I mentioned, we could, spend all day talking about each one of them, right? But I think one of the important things that we missed and that we want to talk about this week is how do we compare the two? If I was like investing and I've been in this market for 15 years, and if someone asked me whether they should have strategic allocation, allocation versus tactical allocation, I still struggle with the question. Most times it's based on how someone is, what's the approach, whether they have enough time, things like that matter more than what's the best approach. Per se, So what do you think?
Right. So this has been like a pet, topic of mine because different investors, right? They want different things out of the market, and they have different, sort of thresholds of how much time they want to spend thinking about this, right? So one of the biggest problems with this tactical allocation is before this, when I looked at it, I was looking at it on a daily basis, right? So looking at the SMAs on a daily basis and entering or exiting based on that. Primarily because I was looking at it from a levered trading point of view, buying futures or trading futures. But if you had to, kind of look at it from an investing point of view and saying, okay, here's my investment. So why don't you take a tactical approach? And we looked at it from a weekly rebalance schedule, right? So the problem is that it still means that the investor has to look at his portfolio every week, right? So he needs to kind of figure out where is the Nifty or whatever mid cap index is trading, and then make a call on whether it is up or below the 50-day SMA, and then put his trades in. And most investors don't want to do this, right? So they are like, look, I'm kind of like a set it and forget it guy. I have a full-time job. Investing is not my full-time job, right? So can you take care of this for me, or is there something that is more sort of longer term? And I think that's a fair point, right? Because if you're like if you have like a traveling job or something like that, you may not be available on the phone to even approve transactions. So what are you going to do at that point? So depending on the type of the investor, right? So pick wisely. Just because SMA might be maybe the tactical approach gives higher returns. Just don't blindly pick it because of the returns. Kind of evaluate how much work is involved. In maintaining that portfolio. That would be my biggest. My first ask, right? So first ask is know yourself. Um, and the numbers themselves were kind of surprising because so the tactical approach, I think we kind of discussed this in the previous post as well. When you backtest a strategy, the reason why you may be seeing excess returns in the past, one of the reasons, right, is that maybe investors in the past could not get it executed, right?
Yeah.
So before the advent of ETFs or index funds or any of that sort, doing trading the index itself meant you had to buy the basket of 50 stocks and trade those. So executing it would have been a hassle. So the money was probably left on the table because they couldn't get those trades executed. It was not because they couldn't discover or did not discover this strategy. It was just that getting it off off the ground was very difficult. So one of the astonishing things we saw was the SMA strategy and the static allocation, right? Even if you take a simple 50-50 equity bond allocation, the returns have been converging, right?
Yeah.
So on a on a rolling 10-year returns, if you just plot it on plot it together, you'll notice that there's hardly any difference between the two, but the work involved in that tactical approach is a lot more than the static approach. And the other question that was asked, I think, in the forum was, does that rebalancing frequency matter for a static allocation, right? Um, Before recording this, we were talking about how, in a static approach, say you started with 50-50, market goes up, it becomes 55-45, then you sell, you sell the, Nifty in this case, you sell the equity portion, down and bring it down to 50. So how often should you do this? Should you do it once a month or should you do it once a year? So that was another surprise for me personally, was that it frankly did not matter whether you did it once a month or whether you did it once a year. When you do it once a month, obviously your returns over your holding period is going to vary based on where you started, right? In the chart, it's called a violin plot. So if you plot the 10-year rolling returns, of a monthly rebalanced static allocation, you get a range of outcomes, right? Based on which month you started. Your annual rebalance, which is shown as a red dot in that chart, actually mostly falls within that distribution, right? It falls within the distribution that you get if you do a monthly rebalance. So overall, even from a statistical point of view, it doesn't matter whether you rebalance monthly or whether you rebalance annually. And even when you consider the full time period from 2004 through now, it still doesn't matter whether you do it monthly or yearly. You end up in the same place. For a lazy investor who just wants to do this once a year and forget about it, um, it's the best setup that you can ask for, right? So just pick your index fund, pick your debt fund. Once a year, you just sit down and you bring it all back towards that allocation strategy. So that makes perfect sense. And the other thing we found was, see, there's a difference between how an SIP investor, someone who is doing a monthly sort of purchase in the market, would look at this compared to somebody who's doing a lump sum, right? Uh, the difference is basically driven by taxes. So a tactical strategy or entails a fair amount of trading, because what happens in a weekly rebalance is also whiplash, right? So if the market is extremely volatile, then you may be buying equities, and selling debt one week, and the next Friday rolls in, and you may be closing out those trades and doing the opposite one and being long the other asset. So this frequent switching, right? It forget about transaction costs for now, because that's mostly zero. But this switching also crystallizes a tax event, right? So you're constantly booking your P&L, and that is not something that you need to worry about if you're an SIP investor. So let's say the markets were markets did great, and now your equity exposure is 55-45, and you want to bring it down to 50, right? You don't have to sell anything, right? You just buy bonds, right? So when you buy the asset that has lower proportion now, you're automatically bringing your proportion back in line. So you don't ever crystallize your profits, right? So that becomes extremely tax efficient. So if you are a SIP investor, if you're doing a monthly or a quarterly purchase, you're better off, with the tactical approach, because you gain a lot by not having to pay taxes. And now I think even long-term tax rates are like 10%. So so that is something that you can save yourself the agony of paying the tax man. So if you're a lump sum investor, you're probably better off with the tactical approach. But if you're an SIP investor, you're better off with a static allocation. That's what we found going through the numbers.
Right. Okay. Yeah, and do you think sometimes? I mean, this would also vary in terms of what in terms of what your basket is, right? I mean, maybe if you have a very volatile basket of say small cap stocks, I would then think that maybe a tactical approach would make more sense.
It really depends. So one of
So
the
so we so we so we saw the data for say Nifty only, right? But if you took the small cap index or mid cap index, maybe this would mean it would mean a different thing.
it really depends. So when I looked at it in the past, what you really want is an asset that trends for the tactical approach to work, right? And you should be careful how you calibrate the trend as well. So we looked at a 50-day moving average, which may be okay for Nifty, but if you're trying to do this for mid caps or small caps, maybe that 50-day doesn't hold, right? Maybe it's some other thing. So I would say that the tactical approach works best if you have an asset class that is trending, and like, and it has to be something that is intrinsic to the way other people are looking at this that same asset class. So when you mention mid caps and small caps, what happens is it is primarily driven by the animal instincts of retail investors. That's how I would put it. Right? Every time there's a mid cap or a small cap rally in India, it's primarily driven by new retail investors coming into the market and and picking up small cap stocks. And what happens is there's this old joke, right? Like a broker calls up his client and he's like, dude, I have like this penny stock, do you want to buy it? So he's like, okay, fine, it's just like 1 cent, why not? So he buys 100 shares. Then he calls him up the next day and says, you remember that stock you bought, it's now gone up 20%, you want to buy it? So he's like, okay, fine, I'd like to buy it. And the story goes on for like a couple of weeks, and then the broker is like, you did a really good job here, you're up 200% or something like that. And he's like, oh, cool, then I like to book some profits, why don't you sell some of them? So the broker goes, to whom? Right? It's like a very common story, right? So so that's what typically happens in small caps. So you keep buying and the price keeps moving up, and then you realize that there's no other side to this. You've just been back.
Yeah. I mean, in India you have a lot of mid cap and small cap stocks which are like operator driven, and stocks which either you have some kind of like pump and dump schemes and stuff like that. But then the trend that you mentioned, that most mid caps or small cap stocks move up when there's a lot of retail interest. That's a trend, right? In a sense, that's a trend that when you're more like broader participation in the market, that's a trend, and that trend moves in one way and then moves back in like another way. So that's a trend also. So I would say that and also if you see the last 20 years, the NSE 500 or the mid cap, the small cap universe has outperformed the Nifty 50, because the extra risk that you're taking by investing in mid caps and small caps, you are compensated for that risk, right? And I would think sometimes that maybe a strategic allocation to mid caps and small caps is not perhaps like a smart thing. I mean, because you will be more exposed to drawdowns, in severe drawdowns. But like a tactical approach, to those might be more sensible, because you do get compensated for the extra risk that you're taking.
Right, absolutely. And there have been attempts to do this. But the biggest problem actually in the tactical approach is liquidity. And if you're trying to do this with index funds, most of them also charge an exit load, right?
Yeah.
So you can't, most of them expect you to hold on for like a month or something. I don't know.
Yeah.
I mean, it's been coming down earlier. That insisted on like a 1 year period and so on, but
But you can't exit and re-enter
right,
very easily. Yeah.
yeah.
But then,
So
Sham, I mean, do you think sometimes that in what we do, the cost is a factor, taxes are a factor, right? And those things add up a lot. Like if you just add up the amount of time you switch between things and you take it over 20-year period, it's a huge amount. I mean, it feels like a huge amount, and so are taxes. Like, but if you just take what is the best thing for the investor, that is always dependent on what kind of a person, and I mean the investor is, right. So if someone has like, you wouldn't put someone on small cap or mid cap stock, someone who's very nervous.
right,
Like,
but
I'm the nervous.
the problem is investors are different based on how the asset is doing. So they are extremely risk taking when the markets are good. So they're like, give me something that can double in value in the next year or two, right? So so they want to take that risk. But the minute the market turns and and risk comes back to bite you, they're like, oh no, why did you make me buy this? Get me out, right? So so I think investor behavior switches based on how they
Oh, yeah. Yeah,
uh,
especially I would say that especially true if if like investors are new, or they haven't seen like like 4 seasons,
yeah.
like like markets move towards in like different cycles, and I think most people see equity markets as like a quick way to make money, right.
Yeah.
It's not like if people invest in property. I mean, say that's a strategic allocation, right? If I'm investing in property, I have a 30-40 year view, and that's my strategic allocation. And people view equities as their tactical allocation by definition. So people are making that shift in saying, okay, I'm not buying something. So I think it's a lot to do with mindset also. That if I mean. I mean, people approach equity itself as a tactical thing, because no one approaches saying that I'll buy Reliance. I mean, yeah, okay. I mean, some people will buy Reliance and keep it forever, but I think most people, when they buy equity, they're like, "Oh, is this the best time to invest?" I mean,
Right.
that question comes up like that question itself is a tactical approach that people take. No one buys property. I mean, people buy property and they're like, okay, I mean, there was a time when people used to buy and flip, but when people buy a house, they are thinking, I'll live here forever. No one thinks of that as as don't no one thinks of that of investing liquid assets. I mean, for whatever reason.
Right. I mean, just because you can trade it, doesn't mean that you should, right? So this
Yeah.
instant liquidity thing, yeah, people have been pointing out that this whole private equity stuff, where you're given you're given a valuation once a quarter, right? Based on some mark to model kind of
Yeah.
basis. The reason why it works is because first of all, the statement is once a year. I mean, once a quarter, and not
Yeah.
every day. And it kind of puts a mental block, saying that okay, you have to think long term. It's kind of part of the product design. Whereas any mutual fund or any stock you buy, at the end of the day you get a report saying, oh, this is what it is worth. And I think that's what the if you want people to think long term, I think the product itself, how you report and how you set up the discussions around it itself should be long term. So I think that is something that I don't think regulators like that, because they say, okay, if it's an equity or a market linked product, you're owed an end of the day mark. But but looking at that mark itself is detrimental house every day and saying, okay, right? So it's like built into the product, that illiquidity. So
I mean,
I think
Warren Buffett has this quote, right? If you can, not watch stocks over the weekend and be fine, then you should try it, during the week as well. Like, you play the game not watching the scoreboard, but watching the players. So I would think, the fact that it is liquid and stuff makes people behave and act in a different way. I mean, even for us, the reason why we both, I think, have systematic strategies is because we want to avoid all the emotional biases that come with it. The thing that I think, next week we should talk about is, using, what's happening in today's environment, that, how the market has done in the last 3 or 4 months. The question I get asked a lot is, why have the markets moved up, And, based on what we have spoken in the last few weeks, we'll try to put that into context, in the sense that, the market moved up, but, but why they moved up? Because, people think economically we'll be still in a rut for a while. And we'll explore the different reasons why the markets, behave in, this way. And then we will try to, make it make sense, of the market valuations right now.
Cool. That sounds good. I think we should. This is a good point to stop. And thanks, Kishan, and thank you guys for listening to the episode of Free Float. We'll catch you again next week. Thank you.
See ya.